we talked about liquidity in the traditional sense, which is still valid, but what we have today is an unusual, something we've never seen, huge problem with American corporations and their liquidity. There's been a lot of actions taken to reduce the liquidity issue, but you still need to survive and make profit. But unless you get past your liquidity problem, you can't deal with new strategy. Also will take time. So one of the things that I think is important to get is the ability of the firm to survive prolonged shutdowns and slow resumption of business have to be addressed by the firm. Now, banks have been using stress tests to determine the adequacy of their capital for many years. So what we're looking at is when you stress test a company is you look at their financial assets, both on balance sheet and off balance sheet, and you try to determine under various circumstances what may happen, which a lot of companies obviously didn't do based on what we're seeing so far. So really what you could do is, if it's how you aggregate the data, you could look and I'm going to talk from the bank's perspective first, and then let's take it and maybe look at it from airlines or looking at differently. So the first thing I can look at is individual exposures if I'm a bank. What is my credit exposure to a certain customer? I have to look at what that risk of the underlying customer is. I could then aggregate that at my entire bank, that how do all these individual exposures add up to the institution, and we could do it system-wide, all of the banks in the US. And you could do that on each bank, a bottoms-up approach, if you will. So each bank would look at individual exposures, then put it together as individual institutions, and then a group like the OCC or the Federal Reserve would pull them up. The other thing is to start at the top with aggregate economic data and drill it down. Now, probably the one that if we're trying to get the best handle would be individual exposures building their way up. However, we don't always have that information available, and it takes time to do that. I had to do this a number of years ago, where I literally worked around the clock for 4 or 5 days. We were sitting in a meeting in a conference room, Buffalo, 24th floor, and I can still see our executives on both sides of me, and I was in the middle. I'm there just as a finance guy, and control the currency says, you guys should put $100 million in your reserve for loan losses. And the chief executive officer come back and says, we'll do 10. And obviously a gap of 90 million is real money. So what I had to go about and do is do a stress test on all of our large exposures. So I probably went through 2,000 credits with the help of others as we put it together. Bottom line is we didn't put 100, we didn't put 10. I think we ended up at about 45 million. So that was a good year. So that's how it started in banking. And then we looked at the methodology, sensitivity. So if we're looking at a hotel, what's the occupancy rate? So if we make certain sensitivity that a 10% drop in occupancy rate would impact the cash flow of the property and thus the value. We created different scenarios. Contagion analysis, and contagion is when it spreads, but you don't know who's got it. It's like a disease. We know somebody may have it, so everybody is potentially guilty. So now you say, how are we going to do this in the area of finance? So what we're going to have to do, and this is one that I have learned from, and in our student managed investment funds, we've had to deal with. So when you look at it, the COVID-19 virus, major disruptions, major. From a financial statement, we know that few things at this point. Revenue is going to be negatively impacted for most companies. On the expense side, there will be increases and decreases, but a lot of expenses don't go away. Therefore, we know we're going to have lower net income and lower cash. But the firm still has to pay its liabilities. In many cases, it's still paying its employees, paying for a factory or process or a supply chain that's in place. So I think if we look at it today, I think there's two things that will define companies that will survive and prosper. The first of them is a very strong fortress-like balance sheet, which includes off-balance sheet access to additional credit. Now, if you're going to have that additional credit, you're going to have to pay it back. So that's where it becomes very important that the company's long-term strategy has got to be solid. The company may suffer short-term disruption, which essentially means evaluating their strategy is what we need to do. Now, some companies, if we look at it the way it is today, now we can't look at this in isolation, okay? And I think this is a chart that when you look at it, it looks at food. And when you look at it, you can see that the supply chain, by the time it finally gets to you, the consumer, it's got to go through a retailer, wholesaler, processor, farmers. And this is a integrated supply chain. It's a movement of goods, information, transfer, purchase, and sale. So all of these become relevant. We can't just look at one company alone. We have to look at how its supply chain works as part of the strategy. Because you might have the best process in the world as a wholesaler, but if there's a problem up here with farmers or processors, that flows down. So we need to be aware of that. Now, for many organizations, near-term survival is the only agenda item. They have to survive. We're seeing that in the airline business today. Others are peering through this foggy thing and thinking about how to position themselves once the crisis has passed and things return to that new normal. But the question is, what is that new normal going to look like? Well, no one can say how long this crisis will last. What we find on the other side will not look like the normal of recent years. And I think, and I'm just a little bit off task on this one, is, in my opinion, this also applies to you and I. Not just survival, but how can we see the opportunities when things return? What is this new normal? So what I'm going to do now is I am going to walk you through the stress test I'd like you to perform. I'll show you how to do it on Steel Dynamics, and you have to go and do it on your company. What we have here is if you come down on the June 2020 file and you work your way over to stress test, everything is there. So the first step we engage in is determining the liability. Remember, we have on-balance sheet, off-balance sheet. So if we're starting right here with our liability and the balance sheet says at 12/31, we get total current assets, which comes from the liquidity page, current liabilities, which also comes from the liquidity page, and it gives us working capital. Okay, that's a liquidity, but remember that it includes accounts receivable, includes cash, short-term investments, accounts receivable, inventory, and prepaid. Then I found that they have available credit, $1,158,039. Where did I find that? I went over to the notes to the financial statement and I put them right in here. The company entered into a new unsecured credit agreement, which provides for a $1.2 billion unsecured revolver. Okay, and there's $42 million outstanding on letters of credit and other obligations. So we were able to find out that they have $1.1 million. So their total liquidity is about $4.4 billion. Now, that's the starting point. Now, on the surface, that may appear to be good. Now, what we want to do is this long-term debt, when we look at the notes, we see that under the facility to access this $1,158,000, okay, the company must maintain an interest coverage ratio of not less than 2.5 to 1. And they define how it is calculated. They also have another covenant. In addition, a debt to capitalization ratio of not more than 0.6. Okay, so we now know they were in compliance at 12/31, and they said they anticipate remaining in it. But that's what everybody thought they did prior to COVID-19. So the first thing we do is we're going to go through and say, let's test these assets here that we think are part of liquidity and see how that affects working capital and how it impacts how much expense coverage ratio they have. So I broke it down. Again, this came from liquidity, and I made various assumptions that the cash is obviously worth 100%, but accounts receivable only 90% would be recognized, 75% or zero. I said inventories, which can include, remember, inventories can include raw materials, work in process, and finished goods. So I said they're probably worth 75 cents on the dollar for this stress. Liabilities are equal. So I came down that I reduced the working capital. I did it under 3 scenarios. Basically, this one went 90, 75, 0, 75, 50, 0. This is sort of our worst case, okay? So that it would range where they are today of $3.2 billion all the way down to $636 million. Then I said, let's look at that working capital in relation to the expenses. Total expenses, this comes from the income statement, all expenses, including cost of goods sold, and $9.4 billion. I made an assumption, an estimate, based on what I read of raw materials. So they're not going to have it. If they're not producing anything, they're not going to need any. So their expenses are $5.5 billion. That includes keeping everybody on the payroll. So they would have enough for 216 days, 197, 176, and 59. So when I look at this, okay, you're going to find that they have enough working capital to sustain. Not going to be pretty, but they can do it. So now when you go do this, and you want to put if you're doing airlines, you've got to put the air traffic liability in. You're going to find some companies don't pass the stress test. Okay? The next thing I did is said, let's look at the fixed payment obligations of the firm and say, will the cash flow be able to support them? So again, I started $1,396,290. Less cap expenditures gives a simple cash flow of $847. And then I stressed it, reduced it by 25%, 50% to see how much simple cash flow would come out. But I also reduced the capital expenditures and acquisitions. Now, when you go to the notes of the financial statement, you should find that what are the payments due by period. So when we look at all of the commitments they have, you see they owe $1,206,000. Okay? And in this case, there's going to be a shortfall. Based on what happened in 19, they are not going to have sufficient cash flow from operations to cover their fixed payments. So what are they going to have to do is they're going to have to use up some of this working capital. So this is a little bit of a concern to them. Now this part of the note right here, you'll find, is that it explains each period. And they have a lot here, construction commitments, as they are building a new plant. So as much as they may not need that plant, if it's underway, they are committed to buying it. So these things here, we find a lot in the notes to financial statement. So we want to take a look at the notes for long-term debt. We want to take a note on the contractual obligations. And then we want to do these stress tests. What ifs? And that, if you do that, you'll be able to conclude what that is. So hopefully that makes sense, and you'll find that here, and you can try to see how it works with your companies. If you have any questions, please let me know.